You might think you understand what it means to actually own a share of a company. I mean, the narrative you're all taught is pretty straightforward.
Yeah, the classic textbook definition.
Right. You put your money in, the company uses that capital to grow, and then in return, you get a share of the profits. You're a partner in the enterprise. It's basically the absolute bedrock of modern capitalism.
It is. That's the story. Anyway.
But today, we are doing a deep dive into something that completely shatters that story. We're decoding this hidden financial mechanism that allows billionaires to use other people's money to buy up, well, entire nations, basically, while risking almost none of their own actual wealth.
And when you say buy up nations, it's not really an exaggeration. It fundamentally reshapes how you look at the stock market. Because by the end of our conversation today, you're going to realize that the traditional rules of business are often just a cover story for the ultimate inside job.
Yeah, an inside job that looks totally legal on paper. And to unpack this, we have a truly groundbreaking piece of academic detective work.
We do. We're looking at a 2003 study by Professor Si-Jin Chang from Korea University. It was published in the Academy of Management Journal, and it's titled Ownership Structure, Expropriation, and Performance of Group-Affiliated Companies in Korea.
Which I know sounds super academic.
Right. The title is very dry.
But do not let that fool you. Because Professor Chang used this massive, unassailable data set to mathematically prove the existence of an invisible system of corporate plunder. He tracked over 3,000 observations of Korean corporate data over 11 crucial years, from 1986 to 1996.
Yeah, looking at the micro-level financial and equity data of 419 different firms, this isn't just looking at profit margins. This is the kind of data that traces the hidden pathways, like who bought what, who owed what to whom, and how these founding families moved their chess pieces in the dark.
So to really understand the sheer scale of what Professor Chang exposed, we have to start by setting the stage. We need to talk about the Chaebols.
Right. For anyone unfamiliar with the term, Chaebols are these massive family-controlled business groups. They essentially built the modern South Korean economy from the ground up after the Korean War.
And we are talking about names that are globally ubiquitous today.
Absolutely. And these aren't just companies that make one thing. They operate across wildly different, totally unrelated industries. Like a single Chaebol might own, say, a semiconductor manufacturer, a massive shipbuilding operation, a telecommunications network.
Maybe a chain of luxury hotels.
Exactly. And an oil refinery. Just everything under the sun.
But okay, if I'm looking at their public filings, on paper, these look like entirely independent companies, right? Like they have their own ticker symbols on the stock exchange, their own public shareholders, their own boards of directors.
That is the legal facade. Legally, they are independent entities, but functionally, operationally, they operate like divisions of a single, giant, monolithic organization. And at the very top of that monolith sits the group headquarters, completely controlled by the chairman, who is, almost always the descendant of the original founder.
So the chairman coordinates the strategy for all these quote-unquote independent companies as if they were just different departments down the hall from one another.
Precisely. Which brings us to the historical inciting incident of this deep dive. Because leading up to 1997, these Chaebol empires looked absolutely invincible.
Right. If you look at the macroeconomic data of South Korea from the late 80s through the mid-90s, the charts of their asset growth are practically vertical. I mean, you were the engines of the miracle on the Han River.
They were borrowing heavily, expanding aggressively into global markets, and foreign capital was just pouring in because the returns looked phenomenal. The growth was staggering.
But the foundation of that growth was built on a series of complex, hidden, interconnected structures. And when the macroeconomic weather changed in 1997,
the whole thing just collapsed. Those seemingly unshakable mega empires collapsed with a speed that genuinely shocked the global financial system.
It wasn't just like a bad quarter for earnings. The 1997 Asian financial crisis was a devastating national tragedy. Foreign capital realized the numbers didn't add up and just fled en masse.
Yeah, the national currency, the won, went into absolute freefall. Banks that had lent billions to these Chaebols failed. A wave of corporate bankruptcies swept the nation.
And it wiped out the life savings and employment of millions of ordinary families. The country actually had to secure a massive bailout from the International Monetary Fund just to keep the lights on.
Yet, and this is the crazy part, amidst all that systemic ruin, the founding families of these cables, the actual architects of the system, they often walked away completely insulated.
Wait, really? Their personal fortune survived?
Largely intact, even as the public companies they managed went totally bankrupt.
See, that is the central mystery we're solving today. How do they pull that off? How do you build these sprawling, multi-billion-dollar empires primarily on the backs of public investors and bank loans, maintain absolute dictatorial control, siphon off the wealth during the good times, and then just leave the public holding the bag when the entire system collapses?
To understand the mechanics of that crime, we first have to understand the conventional economic wisdom that provided their perfect camouflage. We need to examine the foundational theory that regulators and investors basically believed they were operating under.
Okay, let's get into the core theoretical conflict of the paper then. The myth of the good major shareholder.
Right.
Because for decades, the entire Western financial and legal system has been operating on this foundational idea called agency theory. And Professor Chang traces this all the way back to a landmark 1932 book by Adolf Bertle and Gardner Means.
Agency theory is basically the lens through which almost all modern corporate governance is viewed. The core problem Bertle and Means identified way back in the 1930s was the separation of ownership and control.
Meaning, the people who own the company aren't the ones running it.
Exactly. In a typical large modern corporation, the people who actually own the company, the scattered thousands of retail shareholders, they are not the people running it on a daily basis. The daily operations are handled by professional managers, executives.
I can totally map that onto my own life. Like, I own some index funds, which means I own microscopic fractions of major airlines, tech companies, banks. But I am definitely not the one deciding what kind of software the bank uses, right?
Right, or what the airline's marketing budget should be. You delegate that to the CEO.
Yeah.
And that delegation creates what economists call an agency problem. Agency theory posits that these professional managers, if left completely to their own devices without any oversight, are naturally going to pursue their own personal interests at the expense of you, the shareholder.
Because it's not their money they're spending.
Exactly the issue. A manager might decide to, say, buy a fleet of corporate jets or give themselves lavish executive perks or aggressively expand the company's size just to boost their own prestige and salary.
Even if that expansion actively destroys shareholder value.
Exactly. Or, alternatively, they might become overly cautious. They might avoid necessary business risks just because they want to protect their comfortable, high-paying jobs. These inefficiencies are categorized as agency costs.
So in the classical Western view, the managers are assumed to be a bit self-serving, maybe a bit greedy, and they require intense adult supervision to keep them focused on making profits for the shareholders.
That was the prevailing view. So the question for financial economists in the 1970s, particularly scholars like Michael Jensen and William Meckling, was basically, how do we solve this? How do we build a system that forces managers to behave?
And their proposed solution was concentrated ownership, the ultimate watchdog.
Precisely. The logic goes like this. If you have a massive dominant shareholder, let's say a founding family that retains 30 or 40% of the stock, they have a huge financial incentive to watch those managers like a hawk.
Makes sense.
Because they hold such a large block of voting shares, they have the actual power to fire bad managers. And because they have so much of their own personal wealth tied up in the firm's equity, they are highly motivated to ensure the company is run efficiently.
That makes intuitive sense to me as a retail investor, honestly. If I buy a few shares of a company and I see that the founding family still owns 40% of the business, I feel safe. The theory tells me their interests are perfectly aligned with mine.
Right, you feel protected.
Yeah, like if the stock price goes up by $1, I make a few bucks, but they make hundreds of millions. If the company issues a dividend, we both get paid proportionately. We're sitting in the exact same boat, pulling on the exact same oars.
That is the comforting Western assumption. And for a long time, numerous empirical studies looking at markets in the US and the UK seem to back it up. The data generally showed that firms with a concentrated block of ownership often exhibited higher performance and better valuations.
But this is where Professor Chang's research drops a massive, counterintuitive reality check on the entire field of economics.
It upends the assumption entirely. Building on broader global context from scholars like Laporta, Chang points out that the positive relationship between concentrated ownership and good performance is highly conditional.
Right.
It really only holds true in countries that have highly efficient, transparent capital markets and, most importantly, ironclad legal protections for minority shareholders.
Markets where the legal system actually enforces the rules against insider dealing.
Right. But in the vast majority of the rest of the world, including rapidly growing emerging markets like pre-1997 South Korea, that fundamental separation of ownership and management, the very problem Burla and Means were trying to solve it, hasn't actually happened.
Because the founding families never actually handed over the reins.
They retained absolute control. The controlling shareholders aren't just sitting on the board watching the professional managers, they are the managers. Or they directly appoint their loyalists, their family members, their cronies into all the key executive positions.
Wait, let me process this. If the family is both the dominant owner and the dominant manager, then who is watching them? You're saying the watchdog isn't guarding the house.
No, not at all.
The watchdog is actually the one sneaking out the back door with the family silver, and there's literally no one there to bark at them.
That is the exact dynamic. What this study reveals, through rigorous data, is that in environments with weak legal protections, having a dominant, concentrated family shareholder does not protect the company from greedy managers. Instead, it turns the company into captive prey for the family.
Wow. That fundamentally shifts how you view ownership. So the primary battle in these markets isn't between owners and managers at all.
Not at all. The central conflict, the real agency problem, is horizontal, not vertical. The war is between the controlling shareholders, the billionaire founders who run the conglomerate, and the minority shareholders. You, the everyday public investor.
So the traditional alignment of interest that standard business theory preaches is just a complete illusion in this context.
It's worse than an illusion, really. It's camouflage. They use the appearance of being heavily invested to attract public capital, making everyone think they are aligned, when in reality, they're operating under a completely different set of incentives.
Yeah, the paper explicitly uses the word expropriation, that the controlling shareholders systematically expropriate value from the minority shareholders, which is, a very polite, peer-reviewed way of saying they steal from the little guy.
It is systemic extraction.
But logically, I need to push back on how that actually works. Because if I buy stock in a Chaebol company, and the founding chairman also owns a significant chunk of stock in that same company, how do they extract wealth from me without hurting themselves? Don't they want the stock price of their own company to go up just as much as I do?
You'd think so.
A dollar stolen from the company is a dollar they lose proportionately, right?
To answer that, we have to look past the surface-level ownership of a single company and examine the architectural blueprint of the entire Chaebol group. And this is where we enter the labyrinth of control.
The maze.
Exactly. Professor Chang provides a specific, detailed case study in the paper that illuminates this perfectly, the SK Group.
Okay, let's dive into the SK Group case because the numbers here are wild. As of 1997, right before the financial crisis hit, SK Group was the 5th largest business conglomerate in Korea. We are talking about a massive empire spanning energy, chemicals, telecommunications.
The paper includes this fascinating diagram, figure 1 in the text, which maps out the equity holdings of the Chae family, who founded and controlled the SK Group alongside the major affiliates within their empire. When you analyze that map, the math seems to defy the basic laws of corporate gravity.
It really does. The Chae family maintained absolute, unquestioned dictatorial control over this entire empire. They commanded dozens of independent, publicly traded companies. They decided the strategic direction of billions of dollars in assets. But when you add up all the actual personal equity they owned across the entire group, what was the final percentage?
Just 14.1%.
14.1%. That is a staggering disconnect. They control 100% of the decision-making power. They appoint every CEO, they decide which factories get built, they determine the dividend policies, they run the whole show. But they only actually hold 14.1% of the financial risk.
And the remaining 85.9% of the capital is provided by other people, public investors, foreign funds, minority shareholders.
And that gap, the difference between controlling 100% of the voting power but only owning 14% of the cash flow rights, that's the structural engine of the entire expropriation machine.
It is.
But how is that mathematically possible? If I only own 14% of a company, I can be easily outvoted by the other 86% of shareholders. How do they maintain an iron grip without putting up the majority of the cash?
They achieve this through 2 highly sophisticated mechanisms, pyramids and cross-shareholding. Let's break down the pyramid structure first. Scholars like Laporta extensively studied these ownership chains. A pyramid is essentially a hierarchical, multi-tiered chain of control.
So instead of owning the asset directly, you own a company that owns the asset.
Exactly. The family sits at the very apex of the pyramid. They own a controlling chunk, say 30% of Company A at the top tier. Company A then uses its capital to buy a controlling 30% stake in Company B. Company B then uses its capital to buy a 30% stake in Company C.
Let's ground this in the real data from the paper. Give me the SK Group example of how this pyramid was actually built.
Sure. Professor Chang tracks a major acquisition. In 1980, the SK Group acquired a massive oil refining business from the Korean government. But the Chae family did not reach into their own pockets to buy this refinery directly.
Of course not.
Instead, they utilized two of their core public companies, SK Global and SK Chemical.
Companies where they already had control, but where a lot of the capital actually belonged to public minority shareholders.
Correct. They directed SK Global to take a 13.8% equity stake in this new oil venture, and they directed SK Chemical to take a 2.7% stake. This new venture eventually became SK Corporation, the central hub of their energy business.
Wow. Then, as time went on, SK Corporation generated its own massive profits. Did they pay those profits out as dividends to the shareholders? No. The family used SK Corporation's retained earnings to acquire huge equity holdings in other companies further down the chain. Daehan City Gas, SK Energy Sales.
It's a cascade of acquisitions using other people's retained earnings.
It goes even further. In 1994, the group wanted to enter the telecom sector. So SK Corporation used its massive capital reserves to help purchase SK Telecom from the government.
Let me trace the flow of money here to make sure I, and you listening, fully grasp the audacity of this. As an ordinary minority shareholder, I might invest a chunk of my retirement savings into SK Global because I believe their core chemical trading business is strong.
Right.
But then the Chae family, acting as the ultimate authority, takes the cash generated inside SK Global, which is technically partially my money, and uses it to go buy a piece of an oil refinery. And then, a decade later, that oil refinery takes its profits and goes and buys a telecommunications network. That is the precise mechanism. And consider what happens to the family's actual ownership percentage at each step down that pyramid. It gets exponentially diluted. If they own 20% of the first company, and the first company owns 20% of the second company, the family's indirect cash flow rights in that second company are only 4%.
But their control doesn't dilute at all.
Not one bit. Because they control the board of SK Global, they completely dictate SK Global's voting rights in the oil refinery. Because they control the oil refinery, they completely dictate its voting rights in the telecom company. They command the entire vertical chain.
They don't need to spend an additional dime of their personal wealth to expand the empire. They continuously leverage the capital provided by you, the minority shareholder, at every single tier.
Exactly. But that only explains the top-down control of the pyramid.
Yeah.
You also have to factor in cross-shareholding.
Yes, and this is where I find myself genuinely baffled by the regulatory environment, because I always assumed it was fundamentally illegal for companies to just buy each other's stock to artificially inflate their size.
You'd hope so.
Like, I can't start Company A, print 1 million shares, have Company A buy Company B, and then have Company B use that exact same money to buy Company A back, and then we both run around declaring we're highly capitalized million-dollar corporations. That's ghost money.
You are absolutely right, and the Korean regulators were aware of that danger. Direct, two-way cross-shareholding, where Firm A owns Firm B, and Firm B directly owns Firm A, is strictly banned under Korean corporate law.
Okay, so the law worked. The regulators shut down the ghost money.
They shut down the simplest version of it, but they left a structural loophole wide enough to drive a multi-billion-dollar conglomerate through.
Oh, boy.
The law explicitly banned mutual holding between two firms, but it remained perfectly legal if the loop involved 3 or more firms in a circular chain.
You have to be kidding me. That is the most arbitrary legal distinction imaginable.
It's regulatory arbitrage at its finest. And Professor Chang maps this out explicitly in his analysis of the SK Group. Let's look at the actual percentages from the paper. SK Global owns 13.8% of SK Corp. SK Corp, the next link in the chain, owns 18.5% of SK Telecom.
Let me guess what SK Telecom does.
SK Telecom completes the circle. They turn around and hold a 4.1% equity stake back in SK Global.
It's a multi-billion-dollar closed loop. They're just passing the ownership baton around in a circle. They use the capital of Company A to pump up Company B, which pumps up Company C, which pumps up Company A. It artificially inflates the reported capital of every single company in the loop, creating a massive barrier to entry.
It creates an impenetrable fortress. The paper calculates the aggregate effect of this. While the Shea family only personally owned 14.1% of the total group equity, the affiliated companies within the group owned 30.1% of each other's equity through these circular holding structures.
So when you hold a shareholder vote, you aren't just fighting the family's 14%. You are fighting the family's 14% plus the 30% held by the affiliated companies, which the family completely directs.
Exactly. Combined, they command an unassailable 44.2% voting bloc. And because the remaining 55% of the shares are widely dispersed among thousands of individual retail investors, foreign mutual funds, and passive institutional investors who never coordinate their votes, that 44% gives the family absolute dictatorial control over every board seat and every strategic decision.
No hostile takeover is mathematically possible. No activist investor can ever challenge them.
Exactly.
So let's crystallize this for the listener. Why should we care about the exact percentage of a cross-shareholding loop in a 1990s Korean conglomerate? What is the core takeaway here?
The core takeaway is that these structures create a radical mathematical disconnect between two fundamental concepts in business that should always be linked: cash flow rights and control rights.
Let's define those clearly. Cash flow rights represent your actual economic skin in the game. It's the percentage of the actual capital you put in, and consequently, the percentage of the dividends and profits you are legally entitled to receive.
Right. And control rights represent your voting power, your ability to dictate what the company does with its assets. In a normal, simple company structure, those two things operate on a 1-to-1 ratio. If you own 10% of the stock, you provided 10% of the capital, you receive 10% of the profit, and you get exactly 10% of the vote.
The ultimate fairness of capitalism.
But through the labyrinth of pyramids and circular holding, the Chaebol families shattered that ratio. They achieved massive unassailable control rights while maintaining incredibly low cash flow rights. They possess the operational power of an absolute monarch, but they hold the financial risk of a minor passive investor.
And when you separate power from financial consequence, the incentives turn toxic. Think about it. If I have absolute power over a massive pot of money, but only 14 cents of every dollar in that pot actually belongs to me, the temptation to somehow move the other 86 cents into my own personal pocket becomes irresistible.
Naturally.
If I make a bad bet with the company's money, I only suffer a fraction of the loss. But if I can find a way to funnel the gains to myself, I capture all the upside.
You're touching on the exact behavioral shift that drives expropriation, which leads us to the most methodologically brilliant and, frankly, mind-bending part of Professor Chang's research, the great statistical illusion.
Oh, this part is fascinating.
Because if you simply look at the raw financial data, the surface-level performance metrics of these companies, you do not see this plundering happening at all. In fact, if you just run standard statistics, you see the exact opposite.
Right, the false positive. Because if the family is siphoning wealth out, you would expect the companies where the family has heavy ownership to perform terribly.
Right. You would think so. But let's look at the tools economists typically use. If you use a basic, standard statistical tool, what econometricians call an ordinary least squares, or OLS regression, and you plot firm performance against inside ownership concentration, the results initially seem to completely vindicate the old Western agency theory.
When Chang ran that initial simple snapshot of the data, what did he find?
He found a positive correlation. The OLS model showed that companies with higher inside ownership actually exhibited higher profitability.
So a casual observer, a financial journalist, or a lazy regulator looks at that simple chart and says, see, Bertle and Means were right all along. Jensen and Meckling are vindicated. The family is heavily invested, so they act as a great watchdog over the managers. They eliminate agency costs, and the company is more profitable. The system works perfectly.
It looks like a textbook success story, but Professor Chang recognized that this simple OLS snapshot was falling into a massive, well-known statistical pitfall called the endogeneity trap. It is an illusion of cause and effect. It's what researchers call reverse causality.
Okay, we promised the listeners we wouldn't use dense academic jargon without breaking it down naturally. I want to make sure everyone grasps the concept of endogeneity and reverse causality, because this is the moment the entire illusion shatters.
Okay, how do we visualize it?
Let's use an analogy. Let's imagine we're standing on the docks watching a massive yacht club boat race.
I like where this is going.
There are dozens of boats out on the water racing around the buoys, and as we watch race after race, we notice a very strong, undeniable statistical correlation. The boat that the Commodore of the Yacht Club is sitting in almost always seems to cross the finish line first and win the race.
Okay, a strong positive correlation between the Commodore's presence and the boat's performance.
Right. Now, the traditional OLS regression explanation, the naive interpretation, is that the Commodore's presence causes the victory. The assumption is that he is just a brilliant captain. His superior leadership, his watchful eye, and his expert navigation skills cause the boat to sail faster and win. That's the good watchdog theory.
But what is the reverse causality explanation? How does the endogeneity trap flip that narrative?
The reverse causality is that the Commodore isn't steering the boat at all. He isn't adding any value to the speed of the vessel. Instead, he's sitting comfortably on the dock with a pair of binoculars, watching the race unfold. He uses his absolute, unquestioned authority over the entire yacht club to wait until the final stretch of the race. He sees which boat is clearly pulling ahead and is destined to win. And then he takes a speedboat out, pulls up alongside the winning vessel, and uses his rank to commandeer the captain's chair right before it crosses the finish line, claiming all the glory and the prize money for himself.
That is a phenomenal analogy. It perfectly encapsulates the dynamic Professor Chang proved was happening inside the Korean stock market. The simple statistics show that concentrated ownership and high performance move together. But the rigorous data analysis proved that concentrated ownership does not cause high performance. High performance causes concentrated ownership.
It's the ultimate form of legalized insider trading. But I have to push back here on the methodology. It's one thing to come up with a clever analogy about a boat race. It is entirely another to prove that mathematically across thousands of corporate financial records. How do you disentangle the chicken from the egg when you're just looking at spreadsheets of stock ownership and quarterly profits? How did Chang prove the Commodore was jumping into the boat late?
This is why the paper is considered a landmark piece of empirical research. First, Professor Chang didn't just look at a single-year snapshot. He used a panel data technique spanning 11 years. This allowed him to track the changes over time and to control for unobserved firm heterogeneity.
Meaning he can mathematically filter out the unique, constant quirks of specific companies, like maybe one company just happens to own a highly productive patent or has a monopoly in a specific regional market. Things that don't change and might skew the results.
Exactly. He isolated the movement. But even a fixed effects panel data model wasn't enough to fully break the endogeneity trap. To truly prove the direction of the causal arrow, to prove reverse causality, he had to employ a complex econometric technique and two-stage least squares regression, or 2SLS, utilizing instrumental variables.
Okay, let's unpack instrumental variables.
Yeah.
What exactly is an instrument in this context?
Think of an instrumental variable as a kind of neutral testing agent, a tracer die that you inject into the statistical model. To separate ownership from performance, you have to find specific variables that have a strong, proven influence on a firm's ownership structure, but, and this is the crucial part, they must have absolutely no direct effect on the firm's current operational performance, or vice versa.
Oh.
They serve as independent arbitrators to break the mathematical loop.
So you're looking for something that changes how many shares the family owns, but doesn't have any impact on how many widgets the factory sold this quarter.
Precisely. And Professor Chang brilliantly selected 4 specific instrumental variables to run this test: the total equity size of the entire business group, the volatility of the specific firm's past profits, the firm's past sales growth, and the number of years the company had been listed on the public stock exchange.
Let's focus on that last one, listing years, because that makes intuitive sense to me. If a company has been listed on the public exchange for 30 years, it has likely gone through multiple rounds of issuing new shares to raise capital.
Naturally.
So naturally, the original founding family's ownership percentage is going to be far more diluted over time compared to a brand new subsidiary that just went public yesterday. That's just the mechanical reality of equity financing over decades.
Exactly. The longer you are public, the lower the inside ownership concentration tends to be. So listing years strongly determines ownership structure.
But, and here's the key to the instrument, just because a company has been publicly traded for exactly 30 years instead of 29 years, that doesn't magically make their factories run more efficiently today. It doesn't directly alter their current return on invested capital. It's totally detached from daily profitability.
You've got it. It is a valid instrument. By running the 11 years of data through this two-stage least squares process using these instruments, Chang was able to mathematically strip away the illusion of the Commodore steering the boat. He isolated the true causal pathways. And the results of the 2SLS regression were devastating to the traditional Western theory.
What happened to the good watchdog effect? Did it shrink?
It didn't just shrink, it vanished completely. Once he accounted for endogeneity, the supposed positive effect of inside ownership on a firm's profitability completely disappeared. The mathematical coefficient dropped to near zero and became statistically insignificant.
Wow.
The watchdog effect did not exist. Having the family heavily invested did absolutely nothing to improve the underlying performance of the company.
But what about the reverse relationship? What happened when he tested if performance predicted ownership?
The reverse relationship was overwhelmingly strong and statistically robust. The profitability of the firm strongly and positively predicted the level of inside ownership. The causal arrow pointed entirely in one direction.
So translate that into plain English for what the Chaebol families were actually doing behind closed doors.
It means the Chaebol families and their centralized group headquarters possessed perfect, God-level insider information about all the dozens of affiliates in their labyrinth. Because they run the entire structurally independent group as a single, unified entity, they know exactly what is happening before the public ever sees an earnings report.
They can see the future, basically.
Yeah, they know exactly which subsidiary is about to land a massive, lucrative government infrastructure contract. They know exactly which R&D lab has just quietly patented a breakthrough technology that will revolutionize the market.
And before they announce that incredibly good news to the public before they tell me, the minority shareholder who technically owns part of that subsidiary, they quietly instruct the group headquarters to increase the family's direct equity in that specific winning company. They buy up the shares while they are still cheap.
Exactly. They actively increase their stakes in the highly profitable, promising firms, and concurrently, they decrease their stakes in the struggling, unsuccessful, or highly leveraged firms. They use their absolute control over the group's capital to claim the lion's share of the rewards, and then they point to the resulting correlation and disguise it as good management and alignment of interests.
It is breathtakingly cynical. They aren't creating wealth through superior oversight. They're just creating a mechanism for capturing wealth that has already been generated by the operational level of the business. You invest based on the public numbers, assuming a fair market, but you are effectively playing poker against a dealer who can see every single card in the deck and has the power to swap their hand out right before the final river card is dealt.
It's an unwinnable game for the outside investor. But as egregious as jumping into the winning boat is, we haven't even gotten to the most aggressive, damaging part of the expropriation yet.
Oh, right.
Claiming the rewards of a successful company is one thing, but what do the controlling shareholders do when they want to actively move the physical cargo, the actual cash and assets, from a boat they don't own much of into a boat they own completely?
Right. This brings us to the core mechanism of the plunder. The tunneling conveyor belt. Because logically, now that they have this massive labyrinth of cross-shareholding set up, how do they actually get the cash out of the public company and into their own personal pockets without explicitly breaking the law and going to jail?
It's tricky.
Because even in pre-1997 Korea, there were auditors. There were basic accounting standards. The Chae family couldn't just log into the corporate bank account of SK Telecom and wire $1 billion directly to their personal checking account. That's blatant embezzlement.
You can't just wire the money, but you can trade it. And this introduces a critical concept in corporate governance literature known as tunneling. Economists use this term to describe the often legal but highly exploitative transfer of resources out of a firm where the controlling family has low cash flow rights and into a firm where they have high cash flow rights.
Let's visualize the math of tunneling, because it's vital to understand the incentive. Let's say Firm A is a massive, publicly traded manufacturing company. The founding family controls the board, but because of the pyramid structure, they only actually own 5% of the cash flow rights. The public owns the other 95%.
Okay, Firm A.
Now, Firm B is a smaller, privately held company where the family owns 100% of the equity. Every single dollar of value that leaves Firm A and gets moved to Firm B is a massive mathematical win for the family.
Exactly. If they move $100 out of Firm A, the family only personally loses $5 of value. But when that $100 arrives in Firm B, they capture the full $100. They net $95 of value at the direct expense of Firm A's minority shareholders.
But how do you build a tunnel? How do you move the money under the nose of the auditors?
Through intra-group business transactions, you make the companies you control buy and sell goods and services from each other at manipulated prices.
Transfer pricing.
Okay.
So how did Professor Chang find the empirical evidence for this? Did he find the actual receipts?
He looked at the granular financial footnotes that tracked the volume of sales to affiliates and purchases from affiliates for every firm in his 11-year data set. And he meticulously measured how those specific internal transactions affected each company's return on invested capital. And the results were glaring, and they exposed the flow of the tunnel.
What did the data show?
He found a highly significant divergence. When a firm sold goods or services to its affiliates within the group, its profitability, its ROIC generally went up. But when a firm purchased goods or services from its affiliates, its profitability plummeted.
Let's break down how that manipulation works in practice. Let's say Firm A, the big public company where the family only owns 5% manufactures automobiles, and Firm B, the family's 100% privately owned company, supplies the raw steel.
Right.
Because the family chairman controls the executives at both companies, he simply dictates that Firm A will buy all its steel exclusively from Firm B, and they will pay 20% above the fair market price.
And the result is immediate. Firm A's profit margins tank because their input costs are artificially inflated. The minority shareholders of Firm A take a bath on their investment, but Firm B's profits explode because they are selling their steel at a massive guaranteed premium, and the family pockets 100% of that inflated profit margin.
Or they can run the tunnel in reverse. Firm A produces a highly valuable finished product, say, a semiconductor, and sells it to Firm B at 20% below market value. Firm B then turns around and acts as the exclusive distributor, selling that semiconductor to the real global market at full price, capturing the entire profit margin for doing absolutely nothing but sitting in the middle.
Exactly. And on paper, to an outside auditor or a casual regulator, it looks like a totally normal, routine, legal business transaction between a supplier and a distributor. It is incredibly difficult for an outside accountant to definitively prove in a court of law that the internal transfer price of a highly specialized custom widget was artificially tweaked by 15% to favor one side.
Wow.
But when you look at the aggregate data over thousands of transactions across an entire decade, as Professor Chang did, you see the macro effect. A massive invisible conveyor belt constantly siphoning wealth away from the public companies and funneling it toward the companies where the family holds the highest cash flow rights.
That is infuriating.
Yeah.
But it's economically brilliant and in a dark way. However, the paper details an even more insidious mechanism of expropriation than just overpaying for steel or semiconductors. And this is the part of the deep dive that genuinely shocked me, because the scale of the risk is so much higher.
The debt guarantees.
Yes, let's talk about debt guarantees. This feels like the most toxic, destructive weapon in the entire Chaebol arsenal.
Debt guarantees were a defining structural feature of the Korean corporate landscape at the time, and they were the primary fuel for the Chaebol's hypergrowth. The Chaebol chairmen were obsessed with expansion. They constantly wanted to venture into new, entirely unrelated businesses to build their empires. But building a new shipyard or a new auto plant requires billions of dollars. To fund this, they relied heavily on bank loans.
But banks, even in emerging markets, aren't completely stupid. They know that a brand new, highly speculative venture in an industry that Chaebol has no experience in have a high probability of failure. The banks are going to demand massive collateral before they hand over $1 billion.
Precisely. And what collateral did the founding family offer? Did they pledge their own personal mansions or their own private equity?
Of course not. They used other people's money. They offered the strongest, healthiest, most profitable public companies in their group as collateral.
The banks would effectively force the cash-rich, highly successful Chaebol affiliates to co-sign the massive loans being taken out by the weak, failing, or highly speculative sister companies.
It is an incredible abuse of power. I'm trying to think of an analogy for this. Yeah. And it really is like forcing your wealthy, highly responsible, incredibly prudent friend to co-sign a massive bank loan for your gambling-addicted cousin.
That captures the dynamic perfectly.
Think about it. The gambling cousin gets the massive influx of cash to go to Vegas and blow it on high-risk bets. The bank is perfectly happy to issue the loan because they know the responsible friend has a great job at a massive savings account and is legally on the hook if things go south.
Yep.
And the responsible friend who receives absolutely zero benefit from the cousin's gambling winnings is forced to take on all the catastrophic downside risk.
And you have to remember who actually owns the responsible friend in this corporate scenario. You do, the minority shareholder. You invested your retirement savings into a great, highly profitable electronics company with low debt. And suddenly, by decree of the group chairman, your safe company is legally on the hook for billions of dollars of debt racked up by a completely different shipbuilding company in the group that you own absolutely no part of. You assume all the risk. The family pursues all the aggressive expansion.
But here's where Professor Chang's data reveals a dark twist to the debt guarantee system that pushes it into supervillain territory. If you track the family's equity movements during these transactions, what happens to the family's ownership stake when they force a healthy company to take on this toxic debt guarantee?
The data is unambiguous and damning. The moment a healthy company is forced to supply a massive debt guarantee to a weaker affiliate, the family and the other core affiliates mysteriously and rapidly decrease their ownership concentration in that healthy company. They quietly dump their shares on the open market.
So, returning to the analogy, they use their power to force the responsible friend to co-sign the massive loan. And then, knowing exactly how dangerous that debt is, knowing that the cousin is going to lose the money, they steal the responsible friend's wallet and sprint out the back door before the repo man even shows up.
They know they are strapping a financial time bomb to the healthy company. So they use their insider knowledge to quietly reduce their own exposure. They dilute their stake, pull their capital out, and leave the minority shareholders entirely holding the bag when the speculative venture inevitably goes bankrupt and the bomb goes off.
It is the ultimate destructive expression of the separation of control and cash flow rights. They use their unassailable control to force the transaction, but they manipulate their cash flow rights to entirely avoid the consequences of their own reckless decisions. And as Chang's data shows, this wasn't an isolated incident or one rogue CEO. It was systemic. It was standard operating procedure across hundreds of companies for over a decade.
Which naturally leads to the macroeconomic consequences, because you cannot run a system that toxic forever without it catching up to you.
Right, which naturally leads any sane listener to scream at their player, why didn't anyone stop this? Where were the regulators? Why didn't the minority shareholders band together, hire an army of lawyers, and sue the living daylights out of these families for blatant breach of fiduciary duty?
That perfectly transitions us to the broader implications of this research. Because a heist of this magnitude, operating in broad daylight for over a decade, requires more than just a clever financial plan. It requires a completely neutralized security system. And the historical and legal context provided in the text explains exactly why the public was utterly powerless to stop the expropriation.
If this level of tunneling and debt guaranteeing happened today in New York or London, there would be a massive class action lawsuit filed by aggressive securities lawyers before lunchtime. Activist hedge funds would be launching proxy wars to replace the board.
But pre-1997, South Korea was a fundamentally different legal and regulatory environment. The paper relies heavily on the work of prominent legal scholars to map out exactly how disarmed the public was. First and foremost, you have to look at the board of directors. In Western theory, the board is the ultimate safeguard. They are legally bound to protect the interests of all shareholders.
But I'm guessing the boards of these Chaebol affiliates were not exactly independent.
They were completely compromised. The boards were stuffed entirely with internal group executives whose careers depended on the chairman's favor, loyalists to the founding family, and personal friends of the owners. There were virtually no outside, truly independent directors asking tough questions or demanding audits of the transfer pricing.
Okay, the board is captured.
Yeah.
But what about the massive institutional investors? The national pension funds, the big mutual funds, the insurance companies, they hold massive blocks of stock. They have the financial muscle. Surely they could pool their votes and throw these corrupt boards out.
They couldn't. And this is a crucial piece of the historical puzzle. Korean securities law at the time actively and legally restricted the voting rights of institutional investors in corporate governance matters. The law effectively muzzled the only entities with enough concentrated capital to challenge the families.
Why on earth would the law restrict the voting rights of the biggest investors?
It was a legacy of the government's development strategy. The government wanted the Chaebols to have a free hand to drive rapid, aggressive industrialization without being bogged down by cautious bankers or pension fund managers demanding short-term dividends. The system prioritized rapid national growth over minority shareholder protection.
So the big money is legally gagged. What about the retail investors? Could they band together and sue?
Class action lawsuits for securities fraud were essentially non-existent in that legal framework. The legal mechanisms required for a disparate group of small shareholders to pool their resources, hire counsel, and sue management for tunneling were incredibly weak and practically impossible to execute. Furthermore, minority shareholders had severely limited legal rights to even demand to look at the internal accounting books to search for the evidence of the manipulated transfer pricing.
So the investors were blindfolded, gagged, and legally paralyzed. The founding family had the operational power of an absolute dictator, and the shareholders, who provided the vast majority of the capital, had the legal rights of a medieval serf.
Exactly. And this brings us to the catastrophic climax of the story. This isn't just an academic tale about corporate unfairness or inefficient markets. This systemic failure of corporate governance, this unchecked ability to expropriate and leverage other people's money, was the direct catalyst, the match that lit the powder keg of the 1997 Asian financial crisis.
Walk us through the mechanics of that collapse. How does stealing from minority shareholders via transfer pricing blow up an entire sovereign nation's economy?
Because of the cross-shareholding and the unchecked debt guarantees we just spent time detailing, because the families faced almost no personal risk, they borrowed recklessly. These massive Chaebol empires were not built on solid equity. They were built on mountains of hidden, deeply interconnected debt.
The ghost money.
Exactly. A single dollar of actual real equity was being leveraged 10 times over through the circular holding loops and the intercompany debt guarantees. It created a massive house of cards. And when the macroeconomic environment shifted in 1997, when export growth slowed down and interest rates ticked up some of the weaker, highly speculative subsidiaries started failing. They couldn't make their loan payments.
And because of the debt guarantees, the failure didn't stay isolated. The gambling cousin defaulted, and the repo man came straight for the responsible friend.
Precisely. The debt guarantees triggered a terrifying domino effect. The banks called in the loans, forcing the healthy, profitable companies to drain their cash reserves to pay for the failures of the weak companies. Suddenly, the entire conglomerate was starved for cash.
And how did the global markets react?
With absolute panic. When foreign institutional investors who had poured billions of dollars into the Korean miracle looked closely and realized that the equity numbers on the balance sheets were statistical illusions created by circular holding, and that the whole system was fundamentally hollow and rigged by the controlling families, they hit the eject button. Capital fled the country at an unprecedented, violent rate.
Which crashes the currency.
The stock market plummeted. The won rapidly lost value. The domestic banks, which were holding all this toxic guaranteed Chaebol debt, became instantly insolvent and collapsed. The nation effectively went bankrupt and had to surrender to the harsh austerity terms of an IMF bailout. And all of this macroeconomic devastation, the wiping out of decades of national wealth, was fundamentally rooted in the microeconomic failure to protect minority shareholders from expropriation.
It is a staggering historical lesson, but I want to push back a little here on the modern relevance of this specific 1990s data. It is very easy for a listener sitting in the US or the UK or Western Europe today to hear this wild story about circular holding and rigged boards and think, wow, those 1990s emerging markets were like the Wild West. I'm so glad we have a mature, sophisticated, highly regulated system where that kind of blatant theft doesn't happen. Surely this kind of overt expropriation is a relic of the past, or strictly confined to developing economies with weak legal frameworks.
It is incredibly comforting to think that, but it is entirely false. And Professor Chang makes concerted effort in the paper to contextualize his Korean findings globally, citing extensive, groundbreaking research by a famous group of scholars often referred to as Laporta, Lopez de Silenes, Schleifer, and Vishny.
The famous Laporta et al. Studies that mapped corporate governance around the world. What did they find?
They found that this phenomenon, controlling shareholders utilizing complex ownership structures to achieve control rights that far exceed their cash flow rights, is not the exception globally. It is the overwhelming rule. It is highly prevalent even in wealthy, highly developed, heavily regulated countries.
Give me some specific examples. I want to know where else the Commodore is stealing the boat.
The paper explicitly points to some of the most famous corporate empires in the world. Look at the Wallenberg Group in Sweden. Look at the Krupp Group in Germany. Look at the Agnelli family's control over fiat and other assets in Italy. Even in Japan, with the massive keiretsu structures like the Daiichi Kangyo Bank Group. In all these highly developed markets, researchers have found concrete empirical evidence of shareholder expropriation and the separation of ownership from control.
Wait, hold on. Sweden. Sweden is globally recognized as the poster child for transparency, egalitarianism, and good governance. How are billionaires running a hidden expropriation machine in Sweden?
Because the mechanics of control evolve even if the underlying goal remains the same. In Sweden, they don't necessarily use the clunky 1990s Korean style of circular cross-shareholding. Instead, they widely utilize dual-class share structures.
Explain how that works.
It's a structure where the company issues different classes of stock. The public is sold B shares, which entitle them to the economic profits, but only carry 1 vote per share. But the founding family holds tightly onto the A shares, and a single A share might carry 10 votes or even 100 votes per share.
So it's legally baking the disconnect right into the stock itself. You don't need a labyrinth of pyramids if your 1 share is mathematically worth 10 of mine in the boardroom.
Exactly. Through dual-class shares, a family can own just 10% of the actual equity, the cash flow rights, but permanently control 60% of the voting power. And the economic reality remains exactly the same. Wherever that severe gap between control rights and cash flow rights exists, the incentive to tunnel, the incentive to use transfer pricing, the incentive to expropriate fundamentally exists. The paper notes that empirical evidence of tunneling and value extraction has been rigorously documented in the US, in Italy, in Sweden, and in Japan. The mechanics might be slightly more sophisticated, the accountants might use more complex derivatives, the lawyers might wear more expensive suits, but the hidden conveyor belt of plunder is still running right under the surface.
That is deeply unsettling. It completely shatters the illusion that when you buy a stock in a major conglomerate, you are a true equal partner in the business.
It means you have to be aware that you are participating in a system where the rules of gravity, the alignment of risks and rewards apply very differently to you than they do to the people sitting at the very top of the pyramid.
So let's take a moment to summarize the incredible, face-slapping journey Professor Chang's data has taken us on today. We started with the comfortable, textbook Western myth that having a billionaire founder heavily invested in a company is the best possible way to protect small investors from greedy managers. We then saw how, in reality, complex mathematical illusions and arbitrary legal loopholes, like the 3-company circular holding exemption, allow these controlling families to dictate 100% of an empire while holding as little as 14% of the financial risk.
We saw how they use the endogeneity trap to disguise their actions, using perfect insider information to jump into the winning companies at the last second and claim the rewards of success as their own. And we saw how they use manipulated transfer pricing and toxic debt guarantees to legally siphon the actual cash out of the public companies and funnel it into their own private pockets, leaving the minority shareholders to absorb all the catastrophic losses.
And ultimately, we saw how the legal disarmament of the public, the restriction of institutional voting, and the lack of class action rights allowed this expropriation to grow so wildly out of control that it literally collapsed a nation's banking system and triggered the 1997 crisis. Professor Chang's paper isn't just an observation, it is a stark warning about the architecture of power. The only way to stop this kind of systemic plunder is radical financial transparency, aggressive regulations on intergroup trading and debt guarantees, and crucially, giving minority shareholders real, sharp legal weapons like unrestricted voting rights and the ability to easily sue for breach of fiduciary duty.
Because the core truth of the data is this: if you do not strictly limit the power of large controlling shareholders, they will inevitably use that power to enrich themselves at the expense of everyone else. They will prioritize their family's wealth over the health of the company and the stability of the market. That is the fundamental, inescapable nature of the agency problem in the modern global economy.
I want to leave everyone listening with a final, provocative thought to mull over. We've spent this deep dive talking about 1990s Korean chaebols, oil refineries, complex econometrics, and basic transfer pricing. It sounds like history. But look at the world today. Look at the modern tech giants, the massive platform monopolies, and the AI pioneers dominating the global economy right now.
It is a completely different technological landscape, but if you look closely at the corporate charters, the underlying structures of control are eerily, dangerously similar.
Exactly. The billionaire founders of these modern tech behemoths don't necessarily need to use clunky 1990s circular cross-shareholding to maintain their absolute grip. Instead, they use complex algorithms that dictate market access and crush competition. They use endless, opaque webs of offshore subsidiaries and tax havens to hide profits and obscure tunneling. And most visibly, as we just discussed, they use extreme dual-class stock natures, where the special founder shares they hold have 10 or sometimes 20 times the voting power of the common shares they sell to you and me.
They have codified the gap between control rights and cash flow rights directly into the DNA of the modern tech economy. They have institutionalized the very mechanism that makes expropriation possible, explicitly ensuring that they can never, ever be outvoted or fired, no matter how terribly they mismanage the company or how much of the actual equity the public provides.
So when you look at your own investment portfolio today, or when you check your retirement account, ask yourself, are we just repeating the exact same history we discussed today? Has the financial world actually fixed the structural rot that caused the 1997 collapse? Or had the apex predators of the market just updated their technology, hired better lobbyists, and bought better PR? Think about who actually controls the boat the next time you open a stock app and hit buy. Thank you for joining us on this deep dive.